Hi, good morning, everyone. This is Will Hussey with Cook Maran Associates. It's 10 o'clock, so we're going to start promptly. Going to give maybe another minute to let some stragglers join in. Okay, it's 10:01, so in the interest of time, we're going to get started. I want to thank everyone for taking some time out this morning to join our webinar. This is going to be the first of a series of employee benefits, health insurance, ACA-related and AHCA-related webinars that we're going to be doing this year. On the call with us this morning, we have Matt Power, who is the head of the Northeast market for new business development for United Healthcare. Matt's going to be speaking about some of the specifics that we're going to go over in terms of the benefits of self-funding your employee plan, some of the intricacies of all the different insurance aspects, and some of the differences between fully insured. So I want to thank Matt for being with us this morning. Quick background on Cook Maran in case any of you are not aware. You'll see in the heading there, we are a Prime Risk partner. Prime Risk is a national organization of insurance agencies, and we are quickly growing around the country. Cook Maran is a New York, New Jersey, Connecticut-centric agency, but we do have clients around the country. We have commercial insurance, personal lines insurance, and, of course, employee benefits. Our department specifically focuses on employee benefits, so that's what we'll be focusing on this morning, obviously. Quick disclaimer, obviously everything we speak about this morning is general information and is topical. If you have specific questions related to your plan or any of your clients' plans, I know that we have a different contingent of people participating in the call this morning. We have some nonprofit organizations. We have some accountants that have clients that are interested in this topic. Obviously, if you have specific questions, please reach out to us offline. We are going to hold questions during the webinar, again, in the interest of time to get this done in the allotted time frame. Everyone should have my contact information. My email is the best way to get to me. If you have specific questions, please email me after the webinar, and we'd be happy to set up a follow-up call. All right, the agenda this morning: what is self-funding? Explain different types of self-funding. Identify what types of companies should explore self-funding. What are the benefits of self-funding your corporate health insurance program versus a traditional fully insured platform? Explain some of the different various stop-loss insurance protections for employers that do decide to self-fund their program. And then also we're going to go through a real-life example of some of the enhanced reporting and transparency that any employer that decides to go self-funding will receive. And anyone that's familiar with fully insured plans in New York and New Jersey, certain client sizes are right around 100 employees, you tend not to get a lot of detailed reporting, and it can really lead to frustration for CFOs, company owners, because you tend not to know what your annual premium increases are based on. So that's one of the things we're going to touch on. Okay, just some quick definitions. So what is self-funding? Some of the participants may have more familiarity with the concept. Some people, it may be new to some people, so we're going to kind of keep this high level, but also give you a little bit of background so you have a good grasp of the concept. So self-funding a benefit plan is also known as an administrative services only agreement. It's an insurance arrangement whereby an employer provides health, dental, vision, or any other benefits to employees and internally finances the majority of those claims. So all of those words there are important because self-funding is not where an employer has complete exposure to claims. That's somewhat of a misnomer. When you're in a self-funded health insurance arrangement particularly, you do have insurance protection above certain risk levels, and we'll go into that. Also provides health, dental, vision, or other benefits. Really any benefit can be self-funded. Typically, we see health insurance self-funded because that's usually the most expensive premium exposure for employers, but we do have clients that have decided to self-fund dental, vision, and other benefits. And when I say internally finances the majority of claims, that's exactly what it means. It's the majority of claims up to a certain amount. The employer is protected above certain amounts by stop-loss insurance. This self-funding is different from fully insured benefit plans where an employer contracts with an insurance company for a fixed premium to cover employee claims. Self-funding, you have varying claim amounts every month, obviously. In a fully insured arrangement, at the beginning of your contract period, you agree to a certain fixed premium with an insurance carrier, and whether you have a good year or a horrible year, those premiums that you pay are the set amount. Now, sometimes that can work out in your favor, but what we tend to see is that if a client has a positive claim experience, typically below kind of a 75% medical loss ratio range, they're still getting an increase on a fully insured contract basis because the fully insured health insurance carriers will always point to medical inflation or the trend cost inflation to deliver an increase. It may be 5%, 6%, 7%. If a client has a bad claims experience here where it's above a kind of 85 or 90% medical loss ratio, they're going to see a double-digit premium increase, and that's year in, year out. So these things tend to add up on top of themselves. In a self-funded arrangement, an employer assumes the direct risk for payment of claims and is protected from excess exposure via stop-loss insurance. All of these plans are governed by a summary plan document which outlines all of the benefits that employees have access to. Depending on the type of arrangement, the plans can create obligations under ERISA. Very quickly, types of self-funding. There are different types of self-funding. Self-funding or self-insured is what we spoke about earlier. The employer pays for claims for an employee and a dependent up to certain levels, and there's variable monthly cash flow based on claim activity. Level funding is very popular in New Jersey. Employers with 50 employees and above can participate in self-funding. In New York, currently, if you have 100 employees or more, you're able to level fund or self-fund. There is some legislation pending to bring the employee count back down to 50 employees in New York State to allow those employers to self-fund. I think that would be a huge advantage for a number of employers in New York State because it'll bring another option to them. But essentially what level funding is, when I say it's a hybrid, is at the beginning of your contract year, the carrier will determine what they think your risk profile is, and they'll give you a set premium for the 12 months of the year. And at the end of that contract year, they'll adjudicate all of the claims that they've processed, and they'll look at the claims experience based on the claims bucket and premium that they've collected. And if you've had a positive claims year below their expectations, you'll actually get a dividend to offset your next year's claims. And then there's also a captive arrangement. This is a more sophisticated, complex arrangement typically for employers that have 500 or more lives or different types of association plans of like employers. So you may see an association of retailers or an association of manufacturers that decide to enter into a captive, and that program would be self-funded. Okay, this is really a general slide. There are exceptions to this rule, but what types of companies are good candidates for self-funding? Typically, if you have more than 100 employees enrolled on your medical or other benefit plan, and the reason that I say there are exceptions is because, especially in New Jersey, if you have the 50 employee count or right around there, you do have the ability to self-fund. It's a little bit more risky because when you have lower employee count, there's more exposure to variability of claims. But typically right around that 100 employee mark, you're a very good candidate to start consider self-funding, especially given where fully insured premiums have gotten to. Our rule of thumb is that if you have about 100 employees on your medical plan, you're typically paying about $1 million a year in fully insured premium. And at that level, considering that we're seeing kind of mid-single to low double-digit increases on the fully insured marketplace every year, on $1 million base for 100 employees, you're pretty much guaranteed to see, anywhere from $70,000 to $100,000 to $200,000 increases every year on your fully insured contract. So that's where self-funding really starts to become a viable option. Dedicated human resources staff is important because there are components of self-funding where you're going to want to have someone in-house at the employer that's dedicated to really understanding what's going on with the plan. Obviously, Cook Maran, as the consultant, facilitates and really advises our clients on a quarterly basis what claims activity looks like, what different programs they can undertake to really help mitigate claim activity. But you do want to have someone internally that's at least dedicated to the human resources department. Favorable census demographics and a fairly stable workforce are important. And again, Cook Maran and all of our TPA partners can assist in that analysis. But obviously, it's pretty straightforward. If you have a younger, healthier population, you're going to tend to have lower claim activity. A stable workforce is important as well. It's not critical, but it's a good kind of important factor because when you have low turnover, you can tend to get a good handle on what the claim activity is going to be year in, year out. And then also, it's really a 3 to 5 year planning strategy. There is potentially you go self-funding in year one, you may have high claim activity, but over a 5-year time frame, 3 to 5 year time frame, we really have seen our self-funded clients kind of what I say is bend that cost curve in comparison to fully insured, because you can start to control some of the claim activity and input proactive programs, whether it's on the pharmaceutical side or the medical side, or if you have high emergency room claims, you can start to construct your plan design to really mitigate those year in, year out high claim activity. Okay, so I'm going to hand off to Matt Power here. He's going to take over, talk about some of the advantages of fully insured versus self-funding, and then we're going to go through some other illustrative examples of fully insured versus self-funding, and talk about some of the other things in the agenda.
Thanks, Will. Thanks, everyone, for your time. I'm going to try to be as brief as possible, and hopefully during my presentation, you pick up a couple of things that maybe you didn't know before. My background is I've worked with United Healthcare for 24 years. I had a variety of roles. I've worked on the provider side of the business, doing contracts with doctors, hospitals, setting up networks, risk-sharing arrangements, and things of that nature. And for a little bit more than a decade, I've been on the sales side of the business, typically operating in the 100-plus market, 100 to 5,000 usually. And one of the things that we've seen, to kind of piggyback what Will had communicated, and this day and age with the ACA, some other legislative scenarios, clients are getting tired of paying big fully insured premiums because of taxes and what have you that can often be at least 5% on a fully insured renewal, and starting to dip their toe in the world of self-funded, partial self-funded, and certain different risk kind of arrangements. And that's what I look at fully insured and self-funding. For me, if I boil it down to its simplest form, is when you're fully insured, the carrier is taking all the risk. You have 3 people that have horrendous large claims in any given year. The carrier takes the risk on that. Now, you may see that in the way of a renewal if you're an experience-rated group, and typically if you have over 100 people enrolled for over 12 months, you'd be an experience-rated group with most carriers out there. So if you have a group and you don't run very well, and we look at that, and it's really 2 acronyms that we use, BCR, which is also known as benefit cost ratio, or MLR, which is medical loss ratio. They're basically the same thing. It's how much premium we take in compared to how much we pay out in claims. So when you're on a fully insured platform, you're having the carrier take on all the risk for administering your plan. When you go into the self-funded world or partial self-funded, you are agreeing or entering the world where you have some skin in the game. And that means some different things. I don't need to read this slide to you, but there are some things that you will see automatically, some upfront savings. You don't have to adhere to all mandates. You can customize your benefit plans on a self-funded basis. Basically, if you want something to be covered that wasn't typically covered in your fully insured program, we can do that. And I know in the beginning, Will had said that with UMR. UMR is a product that we sell. United Healthcare has several different products that we sell. For example, everyone on the phone is probably familiar with Oxford Health Plans. That's one of our fully insured products. We sell United Healthcare on a self-funded basis, and we sell UMR on a self-funded basis. UMR is our TPA, which gives a lot of flexibility, seamless integration, things of that nature that Will can kind of discuss with you offline. But you'll see some different advantages with self-insurance, whether it's your fixed costs in terms of admin fees. You'll see some discount scenarios as it relates to your claims depending on what network you utilize. I can tell you that our company's standpoint, and I think I speak for the other big carriers out there, the nationals, is we won't look at a group to do self-funding unless there's some claims that we can look at. There are exceptions if you're like a 95 life group and you can prove that you've had some good performance where my stop-loss underwriters will get comfortable with the risk that we're underwriting, we may do it. But typically what happens is we will have experience and we will be able to utilize that experience and kind of rate risk you based on your performance on a fully insured basis. So one of the other things that we see usually is groups typically move to self-funded when they're running very well. And I know that Will had mentioned a number of 75 BCR, MLR, or how we call internally, how are they running? And that's the percentage kind of out of 100 and sometimes, unfortunately, over 100. But I see groups that are even running at 85, 90% will look to come to self-funding because of some of the advantages. And one of the things that I find in rare occasions is that some clients don't necessarily understand what they're getting into when they go into a self-funded environment. And one of the good things about Cook Maran, who I've had the benefit of working with for over 20 years in a variety of capacities, is they know what they're doing. They'll be able to guide you into something that's a good fit for you. Now, where United Healthcare may not have like a level funded product, which we don't. Will had mentioned that before, and there's a variety of reasons of why we don't. One size doesn't fit all, and Will will be able, and his team will be able to walk through what makes most sense for you as clients. So with that said, you can read the slide in terms of what is the advantages and disadvantages, and really the advantages in part when you go self-funding in part up front is cash flow. Because you control the dollars and you're paying claims and you set up bank accounts with us and stuff, and that's the kind of stuff that down the road that we'll talk about if we engage in an arrangement with all of you. So, Will, I think we can go to the next slide. So, a self-funded renewal example, and fully insured versus self-funded. I don't know if you can, how well you can see this, but one of the things that we'll demonstrate to you, and certainly Will would do it, we don't do it, this is one of the Ben ads that Will and his team will have, is that he'll walk you through what your exposure looks like on a fully insured basis, which you're probably very familiar with. Your renewal is July 1, your renewal is 24%, and what Will do is he say, okay, well, I went out to the market and I looked at a few different alternatives for you if you're interested in pursuing some kind of risk arrangement, and here's what your exposure is. And what he will do is craft a plan design for you or a model that says, look, in a fully insured world, your maximum exposure is, let's say, $1.4 million. But your maximum exposure on a self-funded environment may be $1.3 million. So those are some of the modeling that good consultants do. And I know that Cook and Will, because I've worked with them before, they will do this kind of modeling for you to give you a menu of options of things that you can choose from. So there are different things that go into fully insured versus self-funded in terms of your rates and how they're developed. And Will and his team can go over that with you in terms of your fixed cost, your expected cost, and your maximum liability. Those are really your three things that you want to know when you do self-funded. So a renewal example will show you, and AIG is just a stop-loss carrier that we used as an example, can show you the different scenarios that you can experience. The good thing, too, is when you're looking at stop-loss, a lot of times you're not tied to one particular carrier. There are many, many carriers that will quote your stop-loss. Kind of like when you go out to market, or we'll go out to market for you to look at different fully insured solutions. There's Oxford, there's Aetna, the Blue Cross. There are literally, 50, 60 different stop-loss carriers that you can look at to kind of take your stop-loss business, and Will can walk you through that and what that looks like. But this is just a simple example in terms of what your expected claims are, the premiums, and what a renewal would look like. Pretty straightforward stuff. And then, what your claims account for the total cost, what your stop loss is. And stop loss really is protection. That's all that is. It's like an insurance policy within an insurance policy. So you as the group are not holding the bag for huge claims that may come in. So will we go on to the next one?
Yeah, Matt, before we move, I just wanted to point out, this is a client of ours. I've scrubbed it so that you don't see the client name, but what I wanted to really highlight here is on the right-hand side, and the reason I brought this up was because it was actually a tough year for our client, but it's actually very illustrative of where self-funding can help. You'll see that their insurance costs, which is the stop-loss premium, actually went up almost 20%. They were paying on it's about a 300 or 400 life group. They were paying $660,000 just for their insurance, and then the majority of the rest of their cost was their claim bucket. They had a tough year. They had some shock claims, etc. So the insurance carrier increased their increased their stop-loss premiums from $660,000 to $790,000 the following year. So their insurance costs went up almost 20%. But because the insurance cost of the overall program is such a small piece, their overall plan costs went up just under 6%, which, in a fully insured environment is a win. If this group had been fully insured and they had the claim activity that this group had, they probably would have seen a 25% premium increase on their total program cost, which was $4.3 million in 2015. So this is where self-funding really starts to become powerful, is because the increases are on a much lower base.
So in terms of what kind of stop-loss strategies are there, there's individual, which basically protects you from any one person blowing through, let's say, 100,000. We also call it something called spec or specific. So it means that it'll protect you for claims up to a certain number, and then the stop-loss insurance kicks in. Aggregate, also known as AG, is for the group as a whole, and that's really set in usually $1 million, $2 million, depending on the group, how big it is. A lot of this depends on how big you are and what makes sense for your size of the group. And in terms of A-plus rated carriers, Cook typically only works with the carriers that are rated A-plus. We at UMR United have 10 preferred stop-loss carriers that we work with that have well over $1 billion in business with us. And the smart thing about that is, and the good thing about that is, when a large claim hits, you won't see any issues with a stop-loss carrier denying claims, because when they have a case that's with UMR, they automatically will approve a claim regardless of the situation, just because of the UMR relationship. UMR, I should have mentioned before, UMR is the largest TPA in the country. It's a wholly owned subsidiary of United Healthcare, so we have a lot of bandwidth to kind of dictate to some of our stop-loss carriers on how we want contracts structured and what have you. These are all things that, if we go down the path of a proposal, we'll talk with you and handhold you through the process. We can go to the next one, Will. So, as I mentioned, spec or specific stop-loss is really to protect against a large claim for an individual. and basically it would reimburse above a certain amount. Again, it depends on your group size. If you were 110 lives, you're not going to have a spec amount of $200,000 because that's too much exposure for you as the client. The premium would be low, but we would work to craft a plan together with Cook Maran on what we see in the marketplace for your size group, what typically works, what doesn't. But that's spec. Spec is individual. ISL means individual stop loss. So next, which I assume is going to be aggregate. Aggregate just protects the entire group. So, you know, everyone has large claims at some point, and these are little insurance policies to protect you, and fluctuations occur. You could run great for 2 years, 3 years, and all of a sudden get a few shock claims, which we call large claims, shock claims, or HBCs, high-priced claimants. An aggregate is there to protect you in the event you have several large claims, and really it's a precautionary measure. And what happens as the larger the groups get, and I had mentioned before, I work on groups between 100 and 5,000. When you get into the 1,000 life plane, groups usually don't have aggregate because you can spread the risk, and they usually don't purchase aggregate. Some do, just as another level of insurance, but most don't. So with that said, we can go on to the next one. You know what, I'm not going to spend a lot of time on this one, but there are several different stop-loss contracts. We talk about things as 12-12, 12-15, 24-12, 15-12, and what do all those things mean? Those are different contractual terms. A 12-12, which we actually don't sell, is you know, incurred in 12, paid in 12. So 12 is the month. So 12 months. We usually sell 12-15s. So incurred in 12, paid within 15. And one of the things that we want to make sure of, regardless of what the stop-loss contract is, we want to make sure there's no gaps in time or coverage where a claim is going to slip through and not hit the time frame here. So we won't even sell some contracts because we want to limit exposure for the client. Most popular one that I see is usually a 12-15. It's the third one down, and depending on your group size, or a lot of times we'll see groups that maybe if they're in a self-funded environment right now and they're moving over to UMR, they'll want a 15-12. That means that's also something called run-in. And we don't have to talk about that, but there's run-in and run-out and things of that nature. So there's a variety of different things that you can customize, and I know it's a little daunting, but it's actually not that difficult, and Will be the person who would hold your hand through that and explain all the options that are available to you. So with that, we can go on to the next one. So an example of individual and ag, you pay the $25,000 deductible amount. If the stop-loss deductible is $25,000, the insurance company pays excess over the deductible amount. So the most you would be pay is the $25,000, right? And then the amount funded but not reimbursed applies to the aggregate. So it's really to protect yourself. If someone comes in with a large claimant, you're protected. You have a $25,000 specific stop-loss policy. That's all you're going to pay on a $127,000 life claim. Okay? Next. This is something that if you're not asleep yet, this is something that would appeal to you if you're a data junkie. When you move into the world of self-funded, you get a lot more reporting. And I've sold Oxford for a very, very long time, and one of the limitations of our platform in Oxford is lack of data. We do have data, but when you come into the self-funded world, you can get a lot of data. If you don't want it, you don't care to see it, your consultant, Will and Cook Maran, will go through, do quantitative analysis on this data and be able to show you trends, sit down and do meetings with you to say, hey, you've got a high propensity of people using the ER, you've got people that are diabetic, you've got people that are smokers, and here's what we can do in terms of an action plan in conjunction with us to give you disease management programs or different wellness initiatives that you can employ. So the story here is when you're in an ASO group or self-funded, you get a lot more data that's going to tell you more than you probably ever knew before about your actual group and how your group performs from a claim perspective. We also give a ton of information about large claimants, which, PHI and HIPAA and things of that nature, obviously we adhere to all that, so not everyone's going to get that information, but we go to great lengths to kind of give you very specific information about your large claimants. And not just in the fully insured world, we may say on a large claim report, okay, well, someone's got cancer. On an ASO world, we'll go into a lot more detail than just, okay, something has got cancer. Okay, so the story here is that you'll get more robust reporting as frequently as you want it, on demand if you shall choose, and we've got literally hundreds of customizable reports that you could look at. But if most clients, they'll rely on a consultant such as Will to kind of slice and dice the data to tell a story. And then what you do is, I know the next slide that you went to, Will, which is great. This is an example of reporting, which, is different. I don't have to read each one, but you see the table of contents on the right. This is something that you do not get on fully insured, but you're able to get this. And I mentioned a lot of this, high-cost claimants. You're going to get a month-by-month overview. You're going to see your summary and payments. And not just medical. When you go into the self-funded world, you do banking because you're going to pay us from a bank account. There's a couple of different ways we set that up, either our bank or your bank, and you fund your account to cover claims that come in. But we're going to give you banking accounts. We're going to give you utilization reports. We're going to give you hospital reports. So there's a lot of information that can be a little bit daunting. But if you're in good hands, like you would be with Cook Maran, for example, they're going to take this data. They work with this stuff all day long. I know the client that he referenced before because I sold it. I know who the client is. They're a challenging client and are very demanding with data and analytics. And Cook does a great job of being able to kind of tell a story to them and really helping them navigate the waters of their performance from a utilization perspective and engage us with disease management, things of that nature. So the reporting, again, the story is you get a lot more reporting, probably more than you need on the self-funded world. Next. Again, a sample report. You're going to get demographic information about most, some groups know what their demos are of the group, but a lot may not. So we're not only going to tell you how many males and females you know, your average age. We're going to give you really specific breakdowns of what the makeup of your actual group looks like. And that's telling information because if you've got a bunch of millennials, their needs, wants, and claims performance is going to be very different than that of a factory that has a lot of 55-year-old males, for example. You're going to get detailed financial reporting, what your medical per employee per month costs are. How do we bring those down? Where are the areas of your claims performance that we can zero in on and make a difference, right, and bend the trend? So those are the kind of things that you'll see in financial reporting, and I mentioned also about banking reporting. You're going to get diagnostic reporting. We're going to tell you how many of your people have gone for a musculoskeletal issue. We're going to tell you about surgeries. We're going to tell you about how many people in your group had babies. These are things you probably do know maybe a little bit because you talk to your employees and stuff like that, but we're going to give you things like what are your top 5 medical diagnostic categories? Where are the infections? Is it circulatory? Are they blood diseases? And then we'll do it by, we'll drill down. Every report that we do, we start at a very high level, 30,000 feet, and then we're able to drill down into these things and say, well, hold on a second. Someone here on our group has got a lot of surgeries here. Let's dial in and see. Did they go to in-network facilities? If they didn't go to in-network facilities, why did that happen? Because out-of-network is costing more money. What can we do as partners together to try to mitigate some of your high-cost areas? Look, there are some things that you can't control. You're not going to be able to control pregnancies, but can you control diabetes? Absolutely we can. We've got programs specific to that. Smoking cessation, different weight loss, obesity is huge right now. And the only reason that we come out with a lot of these disease management programs is because we're focused on our analytics also. At United Healthcare, we have the largest repository of data in the world. So we're able to do profiling with that data, and obviously obesity is a huge issue. and we're able to come out with programs designed and targeted to bring down the highest cost areas that we see as an organization. So we can move on from there.
Yeah, Matt, before we move on, I actually want to point out, again, this is from a specific client of ours. This is the location service specific reporting. On the right-hand side, for this client, you'll see that 31% ER utilization lower than UMR's norm. It's actually the first line item that's listed under key indicator metrics, ER visits per 1,000, which is a typical standard metric. In 2016, this client had 152. The UMR norm is 200, almost 219. We actually put in a plan design change for this client because they had so many ER visits. We actually decreased the members' urgent care copay, and we increased the members' emergency room visit copay, and we did a big campaign as far as educating the employees that the urgent cares are easier, quicker. Typically, if it's not a life-threatening condition, you're going to get just as good of level of care, and you're probably going to get in and out a lot quicker. So for the client, emergency rooms was one of their biggest cost drivers the prior year. So you are actually able to now change and tweak your plan design, not only for the benefit of the employer who's paying claims, but also to help educate the employee population so they're not now going to the emergency room in a hospital and paying a $250 or $200, or sometimes now we're seeing ER copays upwards of $400. So I think that really is a good illustration of how you can actually proactively change your plan design and positively affect claim activity for the long term. So I just wanted to point
and the other thing that I would add to that is, ER for a large number of years has been one of those cost areas that we've all been aggressively trying to control. And I can tell you the other thing that I talk about probably on a daily basis is the idea of virtual visits. And I'm not sure how many of you have heard of those. It's pretty popular, where you can sit from your smartphone, laptop, or home computer, and you can do a doctor visit for about $45 instead of going to an emergency room or even an urgent care center. And so if you've got a condition, let's say you've got a cold and you need like a Z-Pack, or you've got a skin issue and things of that nature, and I've used virtual visits personally for one of my children one time, and it's so much easier. And I love our pediatrician, but sometimes it's very difficult to get in there. It's a time saver, and from a work perspective, as employer groups, it's a productivity thing where your people aren't going necessarily to a doctor's office, leaving work. They can do a virtual visit, get what they need, and oftentimes it's cheaper than if you went to the doctor's office, assuming you have a consumer-driven plan. So if you have an HSA and you're spending first dollar out of your pocket, it's a huge money and time saver. So, Will, sorry to go off on a tangent, but it's kind of relative to ER.
So before I go through the summary bullet points, because in the interest of time, I know everyone's busy, I do want to let everyone get back to their days. Before I run through the summary on the self-funded topic, I did just want to give kind of a big picture overview. I want to thank Matt for all of his shameless plugs on Cook Maran. We do have a good, close working relationship with Matt and his team at United Healthcare. I don't want people to think that we just do self-funding. We actually, probably the lion's share of our business is in kind of the 25 employee to 200 employee range, and they are fully insured. So we're very well versed in that area. And we actually have kind of stolen some ideas from the self-funding world and introduced them to our to our fully insured clients to help them proactively change the experience of their groups and ultimately help them reduce their annual premium increases. One of the other things that I would mention is if you are a decision maker at a company and you're on this call, I would kind of ask yourself, if you haven't been introduced to the concept of self-funding by your existing consultant, you may want to ask yourself why. And again, a shameless plug, I'll kind of answer that, is on a fully insured basis, a lot of the brokers tend to make more money. It's fixed compensation, and there's a kind of a direct correlation there for them that it's in their incentive to kind of keep you fully insured. When you go self-funding, you have the ability to negotiate your compensation with your consultant, and it tends to be lower and it tends to get fixed. over the life of the contract. So we're not opposed to entering into those fixed compensation agreements. And then the other thing I would say is that we also do handle a number of clients that are under the 100 life group on a fully insured basis. So if you have any questions in that regard, again, please feel free to reach out to us. Everyone should have my contact info there. Just to summarize, don't think that you would be kind of breaking the ice if you consider going self-funding. Over 50% of employers in the U.S. are self-insured, and they have been for a long time. And we're starting to see a lot more employers that have right around 100 lives, 150 employees, go self-funded because of all the advantages we spoke about earlier. Just to summarize, greater claim transparency. I have a number of clients that are fully insured, and every year they're frustrated because they don't get data from the carrier as to why they're getting a 12%, 15% increase. The carriers just don't release the data. Self-funding, you can have increased benefit flexibility. For instance, if you want to cover acupuncture for your employees, you can do that in a self-funded environment. If you want to put in a gym reimbursement program that you can run through claims, you could do that in a self-funded environment. If you want to reduce your urgent care copay, like we did with the client I mentioned, you can do that. So there's a lot of things you can do. Lower fixed costs, we spoke about that in the terms of lower administrative fees. Lower premium taxes. We didn't really go through too much data on this, but on every fully insured contract, you're paying about probably 2 to 3% in taxes, whether it's ACA taxes or New York State or New Jersey health insurance fee taxes. You're paying taxes on your entire premium. When you go to a self-funded environment, your taxes are going to be charged on your insurance costs. They can't tax you on your claim bucket. And as we showed earlier, your insurance costs in a self-funded environment are a fraction of what your total cost would be in a fully insured environment. Nationwide benefit plan consistency. This is something that we didn't touch on, but I think it's important. If you have offices around the country or satellite offices with maybe a handful of employees around the country, but your headquarters are in New York, and your fully insured carrier can't match the plan design that you have for your New York employees in California or Florida or Montana, you can actually completely replicate your plan design for all of your employees around the country in a self-insured environment because you've now determined the plan design. Protection from shock claims via the individual stop loss and the aggregate stop loss we spoke about. So we don't want people to think that if they go self-funded, there's no upside to their exposure. You are capped on your actual exposure. Improved cash flow management. One of the things we actually didn't talk about, it's really a timing difference, but when you transition from a fully insured environment where you're paying a fixed premium every month over to a self-funded environment, the first 3 months of that is going to be a nice boost to cash flow because your claims are not going to go through the claim management system for the first 2 or 3 months. So you're going to see a huge boost in cash flow. Again, it's a short-term boost, but it could be important. And then long-term premium stabilization. You really get off that treadmill of fully insured annual premium increases, 7%, 10%, 15%, 20% we're seeing. In a self-insured environment, if you have a healthy or fairly healthy population and a stable workforce, you can really start to control those annual premium increases, mainly because you're only going to see slight increases on your insurance costs, which, again, are a small portion of your overall program costs. So there's a lot of advantages to self-funding. If anyone has follow-up questions, please email me. We're always happy to come out and meet with clients anywhere around the New York, New Jersey area, or we'll do a phone call. So that's really all we had for everyone today. I think we should get out within 45 minutes. So I want to thank everyone for joining. Matt, I do appreciate your time and your expertise and all of your assistance. Have a great day, everyone, and have a fantastic weekend.